Welcome back to Morning Trade Live. Let's talk some bonds as yields inch higher. Will the slow, gradual climb turn into something faster? Joining us, Giorgio Caputo is the Senior Fund Manager at J.O. Hambro's Global Income Builder Fund. Giorgio, always good to have you on the show. Welcome back. We've got some action in Treasuries finally to talk about. Do you think we should be, or are we just going to get back and stuck within the same range that investors have come to know?
Hi, Oliver. Nice to see you again.
Thank you.
It's a great question. So we are starting to see some movement. And again, it's very hard to predict exactly where, when, and how this will happen, but we're seeing a sign of what could happen at some point in the future. And so the question is, how do we prepare our portfolios for the possibility of higher rates? And for us, this is really one of the reasons that we think fixed income oriented yield investors need to start thinking outside the bond, as we say.
I like that.
Right. I'm glad you do, Oliver. We like it too. And it's a very important thought because, three reasons, right? So first of all, bond yields are quite low, right? You've got your 10-year bond that you bought that's maturing today. You probably bought that for 3 or 4%. You're going to roll that, even with recent moves, you're going to roll that into 85 basis points, right? So the yield isn't there, but there is yield on the equity side. You can still earn 2, 3, 4% yields in income generative stocks, right? So that's number one. Number two is that you can lose money in bonds, right? Remember the taper tantrum back when interest rates spiked up under Bernanke's signaling that he was going to potentially reduce the purchase of bonds at the time. Double-digit losses in long-term fixed income. And the third reason, perhaps the most interesting one, is that we've seen this in the data. Bonds don't diversify like they used to. Mm-hmm. So if you look over the last few months, the negative correlation between bonds and equities, it's actually lower. Mm-hmm. And the key there is when you're up against the zero bond, bonds aren't the hedge that they once were. And so, turn finance on its head. Think about equity income as a hedge for your fixed income, right?
Giorgio, this is where it gets fun. And we can actually see this very clearly for those that are saying, well, hold on, correlations, less negative, more negative. I'll make it even more simple, right? If you're someone who uses ETFs, okay, the TLT, since the September 2nd high in the stock market, TLT is down 4.5%. So your long bond fund here has dropped while the equity market has dropped. But to your point, more specifically, momentum stocks and momentum ETFs that are down 4 to 5%, whereas value ETFs are actually up about 80 basis points. So can we go to like value stocks is now our hedge because the market between stocks has become so bifurcated, momentum versus value, growth and stuff? Is that where we go down a hedge?
Oliver, you hit the nail on the head. Value stocks offer yield and protection against bond losses due to inflation, right? Because your value stock, it's often an industrial, it's a financial, where we've seen them do a little better of late as the yield curve steepens. These are the things that an insurance company or just a regular old income investor can introduce to their traditional fixed income portfolio. They can add to the yield and they can also dampen the risk, as you point out, based upon recent market action.
How much can we project this recent market action, Giorgio? Is this going to be something that continues, or will the Fed swoop in and as soon as we get to 1% or 1.2 or 1.5, or I don't know, Andrew Brenner this morning said that they won't talk yield curve control until we get to 1.5 or 2. But if they do come in, they say, oh, hold on, we're not going to let these bonds sell off. We got a bunch of stimulus to finance and stuff. We got to keep these rates down. We got to keep the bond market intact. Is that then just going to revert us right back to an environment where people buy bonds because the Fed is going to buy bonds?
So the short answer is I don't know, right? Everyone's got their number. When will the Fed come in? What can they do? Are there scenarios where they may try, but the cost of buying another $1 trillion of long bonds to keep keep long-term interest rates anchored at 1.5% is too much. So very hard to predict, but what you can do is prepare. And that's basically what we're talking about here. So build a resilient portfolio. Yes, you need some duration. It's a good place to earn some income. If we end up in a deflationary environment, those long bonds, those utility stocks, those growth companies will be very helpful. But you don't want to have a portfolio that is too tilted one way or the other. You want to have balance. You want to have resilience. To us, when we think of constructing our strategy, that means including things like anti-fragile assets, things like gold, dividend-paying gold miners if you've got an income orientation. So you build a base that is income generative, that is resilient to different shocks, and then you really want to be set up to take advantage of those shocks and those opportunities. We've seen that a number of times over the past few years as we've been talking, shocks in retail preferred markets, shocks in, sometimes it's growth equities, sometimes it's shocks in credit markets like we saw in March. A resilient base, and then take advantage of those opportunities.
Anti-fragile assets. I know some guys who throw something else into that category. Starts with B and ends with Itcoin, but we won't get into that, Giorgio. One question here that I've been asking the bond folks today, I want to make sure to get your thoughts as well, is the relationship between the economy and bonds, where a lot of people think, hey, if there's no inflation running away, then bond yields are not going to go too high. Or if the economy is not taking off, then bond yields aren't going to go too high. Is that the right way to think about it? Or can we have bonds just move because of, I don't know, people decide that they don't want bonds anymore?
Bingo. I mean, I think you want to come back to that point of anti-fragility, right? Human beings, we're all subject to recency bias, where we think a lot about kind of the world as it is today. We're locked down, we're not going to restaurants. But you can paint a picture of a world that's very different. We get a vaccine, which potentially could happen, in the weeks and months ahead. I won't get into to that, but hopefully soon. And then you marry that with kind of a populace that's reemerging, that's reconnecting with the way they once lived a life. Perhaps you get a blue wave on top of that with very significant stimulus. So now all of a sudden we're coming out of our homes, we're spending, and on top of that we're investing in infrastructure. You're investing in greening up the economy, which is actually a very interesting theme for income investors. A lot of those kinds of businesses generate income, and you can see a scenario where you do start to get inflation, as strange as that might seem today. And it's no great shock that you've seen forward inflation expectations cross the 2% line, heading back up to 2.2.25 levels where we haven't been for a while. So it does seem like the market is starting to think about the possibility that you could see a different environment from today.
And then the stimulus part, this kind of overlaps with this. Giorgio, one of the debates in equities is what's being priced in stimulus-wise. I've argued here that it does seem the market's pricing in some stimulus just because the economically sensitive stuff has been outperforming. Do bonds fall into that camp as well? Do you have a view on what size of a deal we need to move the Treasury in the short term higher in yield? It was the talk we get of 1.5, 2 trillion. That's kind of where the talk has been. Is something like that, in your opinion, going to be a yield positive bond negative event, or do we need like a shock number that's 3 trillion to really jack up yields further from here?
I mean, the way markets work when they function properly is they price in probabilities. And so as you point out, we have seen inflation expectations go up. We've seen bond yields start to creep up. And that is the market pricing in clearly a higher likelihood of a Biden victory, a Democratic Senate, kind of the blue wave scenario. When those events actually happen and kind of the uncertainty is removed, it's reasonable to think that yields could go higher from here, that you could see those value stocks appreciate as that gets more and more certain, right? Because there's still conditionality in there. It's a lot, as we've learned, a lot can happen in a couple weeks as far as politics. So again, just coming back to that point, you envision the different scenarios. you have a plan and a portfolio and a sense of what can do well in different scenarios, and then you prepare, right? So you plan and you prepare, and you look to those opportunities where the market gets wrong-footed to take advantage of that stress.
Okay, Giorgio, great stuff. Really like the very clear, precise walkthrough here on how you're communicating with investors on building portfolios right now. Great stuff. Appreciate you coming back as always. Giorgio Caputo, Senior Fund Manager at Hambro's Global Income Builder Fund. Looking outside the bond for income. Fun stuff.